Hi. This works, great. I'm not actually going to talk from the podium because I don't have any slides. You're kind enough to put up with an hour and a half of economics in the middle of your Saturday morning. So I think burdening you with slides that are going to get stale in a couple of days anyway is just inhumane. So no slides. I'm just going to wander around and talk. And what I'm going to talk about, as Amanda said, is the economy. And what I'm really going to do is talk about it in sort of a macro perspective, and that's fairly relevant for forest products generally. And Andrea said I had to say something. My son, who majored in economics, actually works at a paper company. So, you know, I don't know what that means. This is karma. Here we are. Okay, so what I'm going to do is talk about the economy, what I think is going to happen over the near and not so near term, and more importantly, talk about the risks. And the reason for doing that is because when you do economic forecasting, you're never actually right. And so, you know, instead of kind of going through a bunch of slides with an outlook and talking about, you know, what I think is the most likely outcome going forward, that's just not very useful. What's really useful is to talk about kind of where the risks are and how when things move in a different direction than we thought they would, what that means. And so I'm going to spend a fair amount of time talking about that. And then I'm going to spend a fair amount of time talking about labor markets, because labor markets actually are kind of cool. And I'll come back to that as a family matter actually later on. And then when we're all done with that, I'll shut up and we'll do questions. So that's the plan. Let me start with a couple of observations about kind of forest products and the state in which we work. First, the whole trick to kind of thinking about the demand for forest products generically is that it's a derived demand from overall economic activity. It either comes from consumer goods or housing or something else out there. So, you know, there are secular trends in the industry. There are one-off shocks, particularly policy shocks right now, that can affect the industry. But in a secular sense, you know, what happens in the economy and the changes in economic activity are going to be what drives this industry. And so that's really what I think we want to spend most of our time talking about. Another thing that this is just a one-off, but it's kind of cool. We tend to work in Georgia, and as a consequence, we don't pay an awful lot of attention to our immediate environment. And that's kind of unfortunate. As Amanda said, I'm an open economy macro guy. And so I think about how economies interact with one another in a broad spectrum. If we took Georgia as an economy unto itself, the Georgia economy is actually bigger than Sweden. Okay, we're just a little bit short of Argentina, and you know, if Argentina goes to hell, that's a real possibility. We're bigger than them. That's always a possibility there. But I don't think we really appreciate how large we are. You know, as an economy, we'd be one of the top 20 economies on the planet. And that's something that, again, because we have been working in this environment and living in this environment for so long, we just kind of take for granted. But we probably shouldn't, because we are big and we are important. Okay, so let's talk about the outlook. Things look okay. That's it. You know, thank you and good night. You know, there are two important things that are driving the economy right now, and mostly it's consumption, but in a deeper sense, it's labor market dynamics. That, you know, when we talk about the economy's long-term ability to grow, you get growth from two sources. Either you add more people or you make the people that are working more productive. And that's it. So you can take the growth rate of the workforce plus the growth rate of productivity, and that's economic growth. Right now, the economy on kind of an annual average basis is plunking along at about 2.5%. A lot of us think that that's not great, but I want to argue that that's about what we should expect. In the post-war period, we tended to see the economy grow at a pace of right around 4% per year, with a lot of variation from one year to the next, but 4% over a longer period of time. That came from a workforce that was growing at about 2% per year and productivity growth at about 2% per year. And that's where we get this 4% thing. Well, as individuals, we don't really care about growth that comes from adding workers, because that doesn't make us better off. What we care about is per capita output, and that's all about productivity. But if you're a policymaker, if you're thinking in DC or Gold Dome terms, aggregate economic growth is pretty important, because that's kind of where you get your revenue from. And what's important right now is that starting around the time of the Great Recession, we started to see baby boomers age out of the population, or age out of the workforce. And so now we have actually a fairly serious problem that, whereas in most of the post-war period, we're adding workers at a little over 2% per year. Right now it's under 1%. It's about 0.8% per year. If you take that and add about a 2% productivity growth on top of that, you get a long-term ability to grow of, about 2.5%, maybe a little less than 3%. That's where we are, and that is equivalent on a kind of per capita basis to our post-war average. It's just that we had this boom in the workforce during that period that pushed aggregate growth up. So, it's kind of like 2.5 is the new 4, and that's where we're at. Now, another issue that has come up a lot recently is the issue of whether there's an impending recession. And you hear this an awful lot in kind of financial chatter and CNBC and Fox Business News and stuff like that. We have had the last 3 expansions were kind of record-breaking in their duration. And that really got the profession thinking deeply about the nature of business cycles in the US, or the nature of business cycles generally. And I think the consensus that came out of that work is that expansions don't die of old age. They die because something kills them. That there isn't anything that forces the economy. If we're on a balanced growth path, we're growing at about 2.5%. That's about our long-term ability to grow. There's nothing that forces the economy to go into recession simply because we have been in expansion so long. Australia is actually an excellent example here. They have been without a recession for about 3 decades. They missed the Great Recession completely, and they missed the dot-com, and they missed a lot of them. It isn't the case that you have to have recessions and just because we haven't had one in a while. That's not to say that we're not going to have a recession. Of course, at some point that's going to happen. But the people that argue that the expansion is kind of getting tired, no, that's not how it works. Something has to kill it. Now, in the US, what's killed it in every recession in the post-war period has been a spike in oil prices. That in 2007, we had a spike in oil prices, and we had really bad mortgage loans. In 2001, we had a spike in oil prices, and we had the dot-com bubble. Spike in oil prices is pretty unlikely right now. That the nature of kind of fracking technology kind of puts a cap on oil prices, particularly over kind of an intermediate period. That we can get a spike in oil prices in the very short run, but pretty quickly, fracking activity is going to pick up and bring prices back down. So the ability to see a sustained spike in oil prices now is pretty unlikely. There could be something else that triggers a recession, and certainly policy shocks are one of those possibilities. I mean, we look at the tariff issues. Trade and tariff are not as important in the United States as in other industrialized countries, But it's still a big deal, particularly for heavy manufacturing, where supply chains are integrated across many economies. We had the tariff shocks over a year ago. And while it certainly has had some major negative impact on some industries and some localities, particularly kind of the feed grain producing agricultural areas in the US, beyond that, it really hasn't spilled over greatly. I mean, we've seen some rise in prices in imports. We've seen some disruption in some idiosyncratic but noticeable industries that are dependent on supply chains across borders. But by and large, when you look at what has happened so far, it's a little hard to look at tariffs and say that's what's going to kill the economy, even though it looked like a big risk because we really, nobody wins a trade war, and we haven't had one in a long time because of that. And kind of here we are. Well, it turns out that at least so far, the extent of the damage is pretty minimal, or at least not spreading outside the directly impacted industries. So, when you look forward and say, what is it that's going to derail the expansion, it's a little tough to see. Now, as Amanda said, I was at the Fed for 30 years doing monetary policy and open economy macro. And I'm going to come back to that in a second because there are conflicting signals out there. The FOMC meets next week, and I think by and large everybody expects a slight easing of monetary policy, and I'll talk about why in just a second, but I got to set it up first. Overwhelmingly in the US, what drives the economy is personal consumption spending. Personal consumption is 70% of the economy. Okay, that's more than any other economy on the planet. Personal consumption spending is driven by income. People have to have income and then they go out and spend it, and that's what keeps the economy going. Well, that's actually pretty encouraging right now. That if we look at things that would disturb consumers, it doesn't look very risky because there are two kind of important things here. First, you have to be confident in your income stream going forward to continue spending. Well, we're at record low unemployment. And in fact, a week from Friday, or next Friday, we'll get another employment report. We're at 3.7% unemployment. That is extremely low. If you are, employed right now, you have every reason to think that even if something bad happens in the firm that you're at, the ability to get another job and continue your consumption because your income is going to continue going forward, you're on a lot more firm ground now than you've been in really 20 years, more than that, since the late 1990s. So fundamentally, the income stream that supports consumption is really pretty solid. And that's a big reason to not be terribly worried about consumption. The other reason is that consumers' balance sheets are actually in pretty good shape. One of the big things that happened coming out of this last recession was that not much happened. It was, and I'm going to use a technical term here, it was a crappy recovery. We did not do particularly well. In the post-war period, the US has this unique feature about its business cycles that overwhelmingly, again, because we're so dominated by personal consumption spending, the way recessions work is that something goes wrong and there's some, fear about how the economy is going to perform going forward. And so people pull back in their consumption because they're afraid that they may, have to make adjustments later on. And recessions then become kind of self-fulfilling expectations, that if everybody gets afraid, you pull back on consumption, and since that's most of the economy, you end up in recession. But what that means then is, during the recession, most people are pretty much unaffected by the recession. The unemployment rate goes up to high single, low double-digit rates, but most people are pretty much in the same position they've been all along. What that means is that when things get better, you see all the consumption that was put off that caused the recession in the first place, all that consumption tends to occur. And so it's just a matter of shifting timing of consumption. So in the US, if you have a very shallow recession, you have a very shallow recovery. And if you have a very deep recession, you have a very steep recovery. Again, because of kind of the nature of the consumption decisions that are being made here. This time around, we didn't see that. That, as I said, that term is crappy. And it was a really crappy recovery, with consumption growing about in line with overall income growth. That nobody went out and spent a bunch of money that they had the ability to spend. It was mostly a balance sheet recession. People, paid down their debts. It was a painful process. Firms did too, for that matter. And then as the recovery unwound, people didn't go on spending sprees, and to some extent neither did firms. And so we had this sort of gradual recovery that was not an awful lot of fun to live through at the time. On the other hand, it means that now consumers didn't go out and blow up their balance sheets when things got better. And so if you look at debt to income ratios for consumers, they're near historic lows. More importantly, if you look at debt service to income ratios, they're at historic lows, largely because of low interest rates. But there isn't any real reason out there on consumers' balance sheets to get too excited. And so if you combine, pretty sound financial balance sheets in an aggregate sense with pretty solid employment markets right now, what you get is the requirement that a shock that's going to disturb the economy has to be a lot bigger than it's been in the past. Not that can't happen, but I'm just saying that in a fundamental sense, we are pretty well situated right now, given the structure of our economy, to weather kind of small shocks and maybe some not so small shocks. We're actually on pretty solid ground there. Okay, apart from consumption, the next thing to think about pretty seriously, particularly for this industry, is investment. And on the investment side, you really have to think about real estate. Real estate the real estate markets from the perspective of homeowners have largely recovered, in the sense that housing prices are, with some exceptions, basically back to pre-recession levels, if not above. That's a good thing. Most people aren't underwater anymore. That's kind of reassuring. But it's been the case that housing has not kept up with household formation. I mean, and mathematically it has to, and a lot of that has been in multifamily, but a lot of it has also been in doubling up and stretching out the existing inventory. We have not seen new housing starts at levels that we historically would have expected, given the rate at which families are being formed. Again, that doesn't mean, there's been some kind of shift in demand for housing, obviously, and a lot of people talk about that in terms of millennials having different preferences. But the fact is that, if we are looking for a downturn because of an excess supply of housing, single or multifamily, that's a stretch too. That, the fact is that, real estate markets, again, are relatively tight. You can always find places, Detroit, where there's a lot of excess capacity, but no, in general, that's not the case. Things look pretty good here, and again, it's very unlikely that we're going to see some kind of turn down. If anything, the issues about cross-border trade. One of the interesting things about kind of the steel tariffs is its effect on framing lumber prices at the time they were put in. I mean, I realize that there's a lot of volatility there, and it's gone down since then. But yeah, the potential for some kind of disruption is certainly there for this industry, but only because of ill-advised policy, not because of something fundamentally lurking in the economy that's likely to derail construction. The other part of investment that we look at is kind of plant and equipment and intellectual property. That hasn't been going real well. It's in the mid-single digits right now. That was one of the disappointments of the Tax Reform Act, that we had this Tax Reform Act and we thought we'd get a burst of investment spending. And investment spending did go up, but it was well below what kind of models would have suggested we should have expected. On the consumption side, we did do well. That the Tax Reform Act really did perk up consumption overall. I hope that's rain. If it's not, I'm an economist, and so I always plan on the worst. So there are probably frogs coming down or something like that. Anyway, yeah, when we look at investment, things are a little weak. Now, that's not necessarily a bad thing. That a lot of that probably has to do with uncertainty on the policy side. That if you are a major heavy industry, you have to make investment plans that for plant equipment that lasts a long time, and so postponing pulling the trigger on projects right now because of heavy uncertainty about how your supply chain is going to look 5 years from now makes an enormous amount of sense. It doesn't help the economy right now, and that certainly is a problem, but it also suggests that it's not that there's necessarily some shortage of investment opportunities in a deep sense for industry. It's just that as prudent decision makers, they're postponing decisions because you just don't know what things are going to look like a couple of years from now. And for a lot of this stuff, the heavy investment, you need a lot more certainty. And that certainty is going to come. I mean, and that's the trick here, that it's not so, this is the bad thing about uncertainty from a political sense, that it could go on forever, that's possible, but it's pretty unlikely. And to the extent that you judge it unlikely, if you think, well, yeah, after 2020 things might be a little bit more clear, then you're not going to invest in 2019. And I think that's where an awful lot of the lack of investment action right now is occurring, just because there is so much activity out there, or uncertainty out there. The third thing to think about is government spending. Government is a somewhat large player in the economy, not as large as other industrial economies. But one of the things that most people don't realize is that really when it comes to government's involvement in the economy, about 60% of it occurs at the state and local level. That federal spending is far larger than state and local spending, but most of federal spending is transfer payments, that a lot of the state and local activity is financed by federal spending. In terms of the direct consumption of goods and services, really the federal government doesn't consume all that much stuff other than the military. State and local governments, on the other hand, are doing the schools and the roads and the sewers and the fire departments and the municipal services and on and on and on. So again, they're about 60% of government's direct involvement in the economy. State and local governments are in pretty good shape financially. Those segments of the state and local governments, particularly schools that are dependent on property taxes, have seen property tax rolls adjust upwards, and they're in pretty good shape. The rest of the state government that's dependent upon income tax revenue or property tax revenue directed at the state too is in pretty good shape. So again, the possibility of a downward shock coming from state and local governments is pretty remote right now. I mean, one of the big problems we saw during the expansion that limited it in 2010, 2011, was that at a state and local level, it takes about 3 years for property tax rolls to fully adjust to changes in property values, and property values were going down. And so in the beginning of this recession, one of the big things you saw was, as the private sector was doing okay and coming out of recession fairly well, state and local governments were laying off people because their revenue was adjusting downwards, and that really was a headwind for this expansion. But that's over now. And so I think, again, it's fairly unlikely that we're going to see some kind of negative shock there. At the federal level, I have no idea really what to tell you. You know, the deficit's big. It's unsustainable in a very long run sense, but it's not unsustainable in the hair on fire sense that we need to do something right now. We were facing a very serious problem with spending for Medicare and Medicaid that looked like it was going to hit us about a decade from now, kind of the late 2020s or so. That was unsustainable, and we are going to have a serious conversation about what we do about that. It looks like the budget deal that was passed last year, or the year before, is going to bring that conversation forward a couple of years. That because we are running bigger deficits now, and we're going to have to compound that with Medicare and Medicaid issues, or we're going to be in some sort of need of a serious adjustment a couple of years earlier than we otherwise would have. But it was coming anyway. That maybe this is a bad thing to say, but when I was a little kid, meaning in high school, I used to read the reports of the trustees of the Medicare and Medicaid, their annual reports. And I just thought it was really cool because they're talking about stuff that's going to happen way out in the future. That when, you know, what was it going to look like when I was old? And they were saying, well, gee, you know, Medicare and Medicaid are in okay shape right now. This is in the late 60s, early 70s. I probably shouldn't have said that either. But boy, we're going to have a real problem, you know, starting, you know, 2020, 2030 or so. And I thought, man, 2030, I'll be ancient by then. And it turns out that they were right, and that, you know, kind of. That's the kind of beauty of doing demographics is, you know, once you have the population in place, you know how it's going to unfold. You know, they've been saying that this is not really sustainable, particularly once kind of life expectancy increases and you see a lot of people aging out of the labor force. So we've known this has been coming for a long time, and you know, we don't seem to want to have to grapple with this in a serious way, but we're going to have to. And just as an aside, one of the things that I was pretty encouraged with as part of the Affordable Care Act was not so much the Affordable Care Act, but the fact that we started to talk about kind of what the obligation for healthcare spending is in the US, because that's really the conversation we're going to have, and it will be a fierce conversation, as they say. Okay, the final thing to look at, and this is actually quite good, and something that is going to be very good for this industry, is exports. We tend to think about exports as kind of a problem, and in a short-term sense, yeah, we've got this kind of serious trade deficit, but we've had that because of internal imbalances for a long time. In a secular sense, though, our exports are really well poised in the rest of the world. About 5% of the world's consumers live in the United States. A little bit more than that live in the Eurozone, broadly defined. And that means that about 85% of the world's consumers live in emerging economies. And that's actually where all the income growth is now. That if you are an advanced economy, your income growth is kind of limited by productivity growth, which is a function of investment and innovation. But if you're in an emerging economy, you can adopt older technologies, get big productivity bursts, and since you're starting from a relatively low income base, you can see your income grow fairly fast. And that's what's going on. When an economy's income grows, It's consumption bundle shifts. That as your income rises, you start to consume higher value added products. And that's what the United States is relatively good at making. Okay? That particularly here in the US Southeast, we went through a very painful adjustment process, again, kind of starting in the 60s through the 80s, of having manufacturing, low value added manufacturing leave. And that was not a lot of fun, to be sure. But that adjustment is over. And what we did was trade low value added t-shirts for Gulfstream. We're doing wiring harnesses or dashboard assemblies in Georgia, whereas 30 years ago we're doing kind of low value added cutting and sewing. That's what the rest of the world's consumption is moving towards. And so in a secular sense, we're very well poised to take advantage of this. Now, we can screw it up. It's certainly the case that if we kind of don't engage with the rest of the world in trade, Europe is certainly just as easily or as appropriately poised to meet the world's changing consumption patterns as we are. But the fact is that we are good at providing for our own consumption preferences, and the rest of the world's consumption preferences are shifting towards what we do. And that's a really good thing in the long run for US exporters if we kind of play it in a heads-up way. Demand for our products going abroad is going to secularly increase over time, and the market is huge. Again, we're 5% of the world, and the rest of the place is 85%. There's an awful lot of growth that is capable, or possible to take place out there, and we can be major players in that. So, yeah, that is a fairly positive thing. It's not going to happen overnight. There's not going to be one day when everybody wakes up and we get this burst of demand from the rest of the world. But over time, that's what's going to happen. And I think that's a very positive thing going forward. Okay, so that's kind of the real side of the economy. You look around, we got about 2.5% growth. We're fairly well anchored. It is on a sustainable growth path, and I think I think we're in pretty good shape. All that said, we could easily have a recession a couple years from now, but right now it looks like it's going to take a fairly big shock to get us off path. This is something that I would never get to talk about when I was at the Fed, and I'm kind of happy now that I can talk about it. I mean, when you look at what the Fed's looking at, they've got a real problem in the sense that if you look at consumption in the US, things look pretty solid. And that's a big chunk of the economy. Doesn't look like it's in any real trouble. On the other hand, you look at things like financial markets, where you see yield curves inverted, or you look at investment that really hasn't been particularly strong, although you can offer explanations, reasonable explanations as to why that may be transitory. Suddenly a quarter-point cut in short-term rates makes some sense as an insurance policy. We're not seeing any real inflation out there in a systematic way. The FOMC has said they want kind of 2% inflation on an ongoing basis, and that's just not happening. About a little over half of our consumption is in the form of services, and services inflation is really what's been driving inflation for a long period of time. It's been fairly well behaved over the last 15 years. That's a fairly long period of time. We've seen services inflation grow at less than 3%. A lot of that is about medical care, and medical care is kind of weird because medical care inflation doesn't have a lot to do with what you pay in terms of insurance, because you're paying for a lot of other stuff when you go through insurance. Medical care inflation is about what it actually costs to deliver the health care. And really since the recession and the Affordable Care Act, the watchword in the healthcare industry has been cost containment. And it's been fairly effective. That there are financial issues about who's paying for what, but hospitals in particular and the healthcare industry generally has been pretty aggressive about holding down kind of fundamental cost increases, and that has gone a long way towards suppressing overall inflation. That's unlikely to change in the near term. The other thing that's going on holding prices down are durable goods. That if you look at kind of durable goods prices, again, since really the 90s, they've been falling by 2 or more % per year secularly over time. That we are seeing, the price of this TV, this video screen is dramatically lower than it would have been 20 years ago. Those sorts of declines in prices don't look like they're letting up anytime soon. The tariffs certainly interrupted the descent in prices by kind of spiking things up a little bit in the short run. But the long-term trend still remains that it's a function of productivity, and we are seeing durable goods come in at significantly lower prices than they did the year before. And that doesn't look like it's going to end anytime soon either. So the Fed has a lot of room to play here on short-term lowering of interest rates, just because there's not a lot of inflation, and in terms of kind of policy kind of insurance actions, I'd call them, there's some room there. A problem is that a lot of the decision's been politicized recently, and that is troubling. I mean, the FOMC takes great pains not to consider political issues in the actual meeting. And I don't think that will be an issue, but certainly in the larger context of how it's perceived by financial markets, it's a problem and not a good one. But yeah, I think there's a lot of room there for some easing in the near term, just as insurance against financial markets flashing some yellow warning signs right now. Okay. Let me spend the rest of my time, which is like half an hour, talking about the labor market. And this is actually really cool. My family does have an affinity for economics, and that's maybe a little weird. Our kids are really screwed up. There's just no way around that. First Friday of every month, the employment situation report comes out. And that's a rallying point for our family, let's say. 8:30 Friday morning, we're all around the table looking for the BLS press release on this. For good reason, that it is a very important metric in the larger economy. And what you get the first Friday of every month are 2 headline numbers. One is the unemployment rate, and the other is the number of jobs created. Let me talk about the unemployment rate first. There isn't one unemployment rate that, if you took economics, you had to memorize this definition of what it meant to be unemployed and how that's measured. And that actually is a pretty good conceptual measure of unemployment, but it's one of 6 that every month when the employment numbers come out, unemployment numbers come out, there's 6 unemployment rates that are released. Economists, being the clever lot that we are, we have named them U1, U2, U3, U4, U5, U6. The one that gets the headline attention is called U3. And that is the stuff, this kind of standard definition of unemployment. But there are 5 others that are pretty good alternate conceptions of what it means to be underutilized as a worker. It used to be that it didn't really matter which one of the 6 you looked at, because they all moved together. So, the signal that you were getting from U3 would be the same signal that you got from U2 or U4 or whatever. But in this last recession, something weird happened. And this is something that's going to take a little bit of time to talk about, because it's kind of cool. And very relevant for this group. The broadest measure of labor underutilization is U6, and it blew up. The spread between U3 and U6, was tracking around 1.5 percentage points or so for forever. Now U3, the headline number is 3.7%. The broadest measure is 7.7, I believe, about 7.5%. The gap between the two is really big. The gap between the two represents two really important segments of the labor market that deserve some attention. The first are what are called marginally attached workers. Those are people who are not actively seeking work, but would take a job if one were made available. Right now, because labor markets are fairly tight, this is mostly a rural phenomenon. That, if you're in a small town and you're unemployed but would like a job, and nothing has happened to change anything locally for the last few months, there's no real point in your going and annoying potential employers when you know that nothing has really changed. And so you're no longer counted as actively seeking work, which is perfectly rational, but you are available for work if demand picked up in the locality that you're in. The other segment that is important part of that gap between U3 and U6 are part-time workers that are part-time for economic reasons. Part-time labor force in the US has gotten a lot bigger over the last few years, and a lot of that has been technical in nature. That in particular, hospitality, food service has been able, and in retail, has been able to use technology to more tightly schedule workers' hours. That if you are in a restaurant, you don't need most of your staff there for 8 continuous hours. That isn't kind of how demand works. And so you kind of can use this software to, figure out how many people you need at noon and how many people you need at dinner. And that generates a lot more part-time employment from positions that were previously full-time jobs. It's also the case on the part-time side that you've got the gig economies, the Ubers and the freelancers that are, again, part-time jobs by creation. And it's a lot bigger segment of the workforce, of the employment base than has been in the past. But the people that are taking those jobs fall into 2 categories, okay? First, there are the people who want them, that genuinely want part-time work. We associate this with a lot of millennials, but they're called part-time for non-economic reasons. People that genuinely want part-time work. You can think of them as part-time with a smiley face, right? That they like the idea of part-time. The more important segment is this part-time for non-economic reasons. Those are people that have to take part-time jobs because they need the money. And they're either taking jobs that typically would be full-time, but just aren't because there's insufficient demand, like a factory worker where the factory, just doesn't have the orders, so they only run the factory for 30 hours a week. If orders picked up, it would be a 40-hour-a-week job, but it's not right now, and so you're part-time, but that isn't kind of what you had in mind. And there are also part-time for economic reasons people that are taking explicitly part-time jobs because there's nothing else available. That you need the money, and so you're working at a part-time job that is going to stay that way forever because you really need the income. Okay, so it's that segment of the labor force that we think of as being underutilized, that they are ready and willing to provide more hours than they currently are, but that's just not where they find themselves, and so they're counted in U6. Now, the reason I'm spending all this time talking about this is because when we look at kind of headline measures of unemployment, we think, wow, the economy is pretty close to full employment. and by traditional measures it is. Usually with that tightness in the labor market, we would see some pretty hefty wage gains, and we aren't. That we are seeing wage growth on the order of about 3% per year, which is not bad, but it's not indicative of a labor market that is really, really straining to kind of bring in additional workers. And I want to argue that the reason that's the case, the reason that wage growth right now has been suppressed, is because of this gap between these two measures of unemployment. That if you think about the part-time for economic reason worker or the marginally attached worker, they have one thing in common, and that is that if you offer more hours to them, they'll take it at prevailing wages. So, if you are employing somebody, I mean, this is actually a good example here. You're employing a truck driver that's driving a truck for 30 hours a week. And you say, well, look, let's increase your hours to 40 hours a week. They're likely to say, that's great. Not, yes, I'll do it, but I need a higher wage than I was getting before. And until that gap between these two measures of unemployment, U3 and U6, goes back to where it normally is, I don't think we're going to see the kind of pressure on wages that we traditionally have been seeing with the 3.7% unemployment rate. Now, the gap is closing, and we are starting to see more wage growth, but I think until that gap really closes in a serious way, we're very likely to see very tight kind of headline measures of labor market tightness, accompanied by wage growth that is okay, but not really kind of hair on fire, tight labor market times. So I think that's kind of something we need to look carefully at, kind of on a monthly basis when the unemployment numbers come out, although you're not going to get it from the financial press, and I'm sorry about that. There's not a lot I can do about that, even though at the Cunningham family breakfast table, by God, we're there. Anyway. Yeah, if you're interested in this, I produced a little blurb on the employment numbers. Give me your card, I'll just put you on the mailing list. I think it's kind of interesting, and I realize that that's not a commonly shared view of that. The other thing to talk about is the number of jobs created, and then after that I'll shut up. The number of jobs created is really kind of interesting in the US. That on a monthly basis we kind of hear, well, we had 200,000 jobs created this month, or whatever the number is, 150,000, 300,000, whatever. That really doesn't capture what's going on in the labor market. That in the middle of the month, there's this other data release that comes out called JOLTS. That's really pretty cool. It stands for Job Openings, Layoffs, Terminations, and Separations. And it really measures the churn in the labor market. And I think that's something that we really need to kind of pay attention to too. That when we say there's 100,000 more people working this month than compared to last, that's true. That the Bureau of Labor Statistics actually does a pretty good job of capturing that, and that's good for them. But in a deeper sense, what we're really seeing is an enormous churn of people getting employed and people leaving employment, whether voluntarily or involuntarily, and that churn is enormous. That on a quarterly basis in the US, the last quarter, for example, there are about 7.5 million people that got a job, okay? There are about 6.5 million people that left their job, either voluntarily or involuntarily. So in the first quarter of this year, you had 14 million people changing their employment status, okay? Now out of that, we gained net, 250, 300,000 jobs, which is a nice gain, but it really doesn't capture what's going on in the labor market overall. That overall you have this enormous dynamism in the economy where, again, you got 14 million people changing their employment status on a quarterly basis. It shows up as marginal kind of employment gains over time. But the underlying dynamism is really important, that as you leave a job and take another, what you're doing is reallocating labor, which right now is a relatively short resource. And that reallocation can be across sectors, across firms, across geographies, across all sorts of things. But it's that reallocation idea that's really important. That what's going on is you're moving people out of employment that is not as beneficial in some sense as the employment that they're moving into. And so there's this net gain to the economy overall as this churn takes place. And it's not just the 200,000 jobs a month yeah, that's a real gain to be sure. But underlying that, it's the reallocation of labor that really makes a difference in the US, that provides a dynamism to the overall economy that we really don't appreciate in the deeper sense. So another kind of interesting thing that comes out of that is of that jolt state is the quit rate, and this is just an aside. But when quits rate is a wonderful measure of confidence in the workforce. That if you're quitting your job, you're doing it because you're pretty confident that you're going to be able to continue eating. That's an important thing for consumption. And during the recession, quit rates basically went to zero. That nobody quit because a lot of people got terminated because of layoffs, but nobody voluntarily quit. Now quits are about half the number of separations that are occurring in the US. So the quit rate is way up, again indicating that individuals have an enormous amount of confidence in the labor market, and consequently, again, backs this idea that the consumption overall is in really pretty good shape. So with all that, I'll shut up. It's a little early for Q&A, but I don't think anybody's going to mind getting 15 minutes of their life back. All of you are more or less gainfully employed, and all of you probably have credit cards, and all of you probably have credit cards that aren't maxed out. So on your way home after this conference, I want you to buy stuff, okay? Buy stuff and charge it. You don't have to take it home, okay? I don't care what you do with it. But yeah, do your duty, buy stuff, contribute to the economy. So thank you.